of Risk Management Solutions for Bankers Bank, also a certified community bank risk specialist. I'm excited to be your host for today's session. This program is brought to you by Bankers Bank, the Midwest's leading provider of correspondent banking services to community banks. As an independent source of non-competing financial services, Bankers Bank serves a market of over 600 financial institutions and provides a strong portfolio of innovative solutions to help our local community banks thrive and focus on the needs of their customers and communities. Before we get started, I'd like to cover a few logistics. Due to the number of attendees, your phone lines have been muted. Please submit any questions via the chat box, and we'll get to as many as we can at the conclusion of the presentation. Given the popularity of today's subject, if we don't get to your question during the webinar, we'll be happy to reply to those after the webinar is over. We'll be recording this webinar and we'll make sure we'll give you a copy of it along with the slides for all attendees. You'll also be directed to a short survey at the end of the webinar. Please complete it and share any ideas you have for any future webinar topics. Joining me today is Shane Bauer. He's the Compliance, BSA, and Security Officer at Bankers Bank and also leads Bankers Bank's fraud group. He's been with Bankers Bank for 27 years and is located in our Madison, Wisconsin office. For our agenda today, we'll have two segments. The first is fraud trends and your bank's response, and Shane will go over that with you. And whenever Shane wraps up his section, we'll go to your public image and fraud, and I'll talk about a case for managing reputational risk. So we'll go ahead and pass over to Shane now, and we will hear about fraud.
Great. Thank you, Dave, and good morning to everyone. My presentation on this May Day is a high-level overview of the state of bank fraud, followed by a discussion of some ways your bank can respond in this fast-changing environment. Then I'll turn it back over to David, who will talk about reputational risks of fraud. Next slide, please. Unfortunately, no one in the banking industry gets very far in their careers without some exposure to fraud, and that's more true today than ever before, given new methods and technologies being explored by fraudsters. My discussion of the current fraud environment serves as much as a level set as an information dump. What I mean by that is that I'll present the state of fraud as I understand it, in part to provide a better context of the actions your bank can take, and then I'll discuss that a little bit later. We begin with highlights from recent testimony sponsored by the American Bankers Association and a presentation at the Federal Reserve Bank of New York. Then we'll explore some specific fraud types: application fraud, check fraud, account takeovers, payment fraud, card and merchant fraud, and elder abuse. Obviously, with a long list, we'll hit each of those very briefly. Then I'll mention a few things that banks and others can do to mitigate these types of fraud. And as my time winds down, I'll talk specifically about some broad responses to fraud your bank could take, some that are low-hanging fruit, others that may barely be in reach or even out of reach for a smaller bank until certain technologies become more mainstream. Next slide. A month ago today, Darren McLaughlin, Executive Vice President at Flagstar Bank, testified before Congress on behalf of the American Bankers Association. His message was clear. Fraud is no longer just a compliance issue or an operational risk. It's a pervasive and escalating threat to the financial system, requiring coordinated national attention. As Mr. McLaughlin described in his testimony, Bankrate recently reported that 1 in 3 U.S. adults has been targeted by fraud in the last year. Of those, 40% experienced financial losses. That equates to tens of millions of people defrauded, many of them elderly or financially vulnerable. The Federal Trade Commission reported estimated losses as high as $158 billion in 2023, and for seniors alone, the number exceeded $60 billion. McLaughlin emphasized that while banks continue to invest in robust fraud detection systems, employee training, and consumer education, they are increasingly outpaced by the speed and scale of bad actors, many operating from overseas or using technologies that allow them to spoof identities, impersonate officials, and manipulate social media. He called on Congress to consider legislative reform, including changes to the Bank Secrecy Act, reporting thresholds, and to facilitate better fraud intelligence sharing through the Financial Crimes Enforcement Network, or FinCEN. Next slide. Then just a couple of weeks ago, on April 17th, Michael S. Barr, governor at Federal Reserve Bank of New York, gave a well-received presentation at their headquarters in New York City discussing the rise of deepfake facilitated cybercrime. Governor Barr described how generative AI is a budding miracle of modern technological advancement, but also represents many opportunities for misuse, including short-circuiting existing fraud prevention strategies put in place by banks and their customers. Deepfake fraud has grown by 2,000% in just the past 3 years. Unfortunately, this cyber arms race is asymmetrical, and the banking industry is being caught flat-footed. Criminals can act quickly and cheaply, targeting many victims at once. Despite a low success rate, schemes can be highly lucrative. Meanwhile, banks face high costs, slow processes, and severe consequences for every failure. In short, the fraudsters aren't fighting fair. The most dramatic cases today have been in the big business, big bank environment. A UK engineering firm, Arup, experienced a $25 million theft through impersonation of their CEO. At Ferrari, an impersonation of the CEO was narrowly foiled. Deepfakes are being weaponized, and banks of all sizes will ultimately suffer the consequences if we don't strengthen controls. Which brings us to application fraud. Next slide. Application fraud has become central to the fraud conversation in 2025. It's being supercharged by tools like generative AI, which allow criminals to fabricate highly convincing personal documents and identities. These Frankenstein IDs are not entirely fake. They often blend real Social Security numbers or credit profiles with fabricated names and addresses. The result is a synthetic identity that passes many traditional know your customer checks. Criminals use these identities to open credit cards, take out loans, or commit bust-out fraud, running up debt quickly before vanishing. According to Deloitte, synthetic identity fraud could cost U.S. banks upwards of $23 billion annually by 2030. What's more, fraudsters use automation to scale up these efforts, submitting hundreds or thousands of applications across institutions with very slight variations. Deepfake videos and voice tools are used to impersonate real applicants during video verifications. This level of sophistication demands that banks shift from static verification to dynamic AI-driven monitoring of behavioral patterns, device fingerprinting, and consortium-based identity verification. Next slide. Check fraud remains one of the most surprising areas of growth in financial crime. Despite digital banking's dominance, check-based schemes are still rampant, and in some cases, they're evolving faster than digital fraud. This is despite the drop in check volume over years. These include age-old techniques such as washing stolen checks, creating counterfeit checks, forgery, and kiting. According to the Federal Reserve's 2024 Risk Officer Survey, counterfeit checks, payee forgery, and check washing remain among the most difficult forms of fraud to detect and most damaging in terms of losses. Counterfeit checks alone account for increased fraud losses at 34% of financial institutions surveyed. But unfortunately, there are new and improved aspects to check fraud at criminals' fingertips as well. The resurgence in check fraud is partly due to viral misinformation on platforms like TikTok. In one viral trend, users create to me, from me checks, writing checks from their own accounts and depositing them via ATM, then exploiting banks' funds availability policies. Participants believe they're exploiting a loophole, not committing fraud, but for banks, that's a distinction without a difference. AI has also been weaponized to generate counterfeit checks that mimic handwriting, holograms, and bank logos. These forgeries can fool even the most experienced tellers and automated detection systems. To fight these fraud attacks, banks should reinforce manual review processes for suspicious deposits, invest in AI-powered image analysis, and educate customers about the realities of funds availability timelines. Next slide. Account takeover, ATO, continues to grow in scope and complexity. Fraudsters target digital banking platforms, mobile wallets, and cryptocurrency exchanges with increasingly advanced tactics. Credential stuffing remains common. Bots test millions of stolen username password combinations against login portals. Reused login IDs and passwords can be disastrous. Fraudsters don't need to know where a customer has accounts if they test stolen credentials far and wide. But these are well-established techniques at this point and comparatively low-tech. Newer threats include deepfake audio used in customer service scams, as well as AI-generated phishing campaigns tailored to the target's language, behavior, and transaction history. As the FTC reports, account takeover is driven by social engineering and data breaches. In many cases, victims are unaware their credentials were compromised until the money is gone. Preventative measures can be a challenge for small banks with limited budgets, but could include layered defenses such as behavioral biometrics, device fingerprinting, and continuous authentication. Methods that track user behavior like typing speed and mouse movements. Behavioral analytics and anomaly detection can also identify when a legitimate account is suddenly behaving like a mule account, transferring large sums or interacting with new payees at odd hours. Finding ways to scale the scope and cost of such tools to your bank will be a real challenge, but ultimately an unavoidable one. Next slide. Payment fraud spans several transaction types, including both wires and ACH, but the most concerning developments involve faster payments. These newer payment rails, while increasingly popular for their speed and convenience, offer criminals a perfect window of opportunity. Faster payments platforms such as FedNow or RTP provide little time for banks to identify and reverse fraud. Fraudulent funds can be moved out of reach within seconds. In 2025, fraudsters are using deepfake videos in business email compromise schemes to impersonate executives and authorize wire transfers. Malware is deployed to intercept ACH transfers or swap out routing numbers in the middle of a session. The FBI's Internet Crime Complaint Center has reported that email compromise schemes alone cost U.S. companies over $2.4 billion in 2023. Mitigation strategies could include real-time risk scoring, AI-powered transaction monitoring, and stricter limits on first-time transfers. In addition, context-aware authentication, such as verifying transfers based on behavioral profiles, is increasingly essential. Next slide. Card fraud remains ubiquitous. According to the 2025 Global E-commerce Payments and Fraud Study, 98% of merchants globally experienced some kind of fraud in the past year. First-party misuse, sometimes known as friendly fraud, remains one of the most common and costly forms. This includes false chargebacks, fake refund requests, and policy abuse, such as returning used or damaged goods. More than 60% of merchants reported an increase in refund fraud alone. Card testing, triangulation schemes, phishing, and farming and identity theft are all on the rise. Generative AI makes fake shopping sites and customer support scams nearly indistinguishable from the real thing. Real-time monitoring, network tokenization, and strong customer authentication are vital in fighting these sophisticated fraud schemes. Additionally, businesses should improve the quality and detail of their transaction records to support dispute resolution. Education also plays a role. Many consumers don't understand they're abusing chargebacks and are committing fraud. It's not just a customer service tactic, it's fraud against your bank. Next slide. Elder abuse is a growing problem across the banking industry. Recognizing the urgency and severity of elder abuse, on December 4th of last year, federal regulators released an interagency statement focused on identifying and preventing elder abuse. Regulators urged banks to implement robust fraud prevention procedures to combat this fraud technique, to timely follow BSA reporting requirements, to share information about schemes that could affect many banks and their customers, and to focus on outreach and education so that customers are not caught unaware. Elder financial abuse is not only widespread, it's deeply personal, even devastating to victims and their families. Scammers target seniors with schemes that exploit trust, urgency, and emotion. Elder abuse is sophisticated and difficult to detect or prevent. Voice cloning allows criminals to impersonate family members, while chatbots can simulate conversations supposedly taking place with bank staff. Remote access Trojans or rats gain full control of the victim's computer or mobile device. The FTC estimated that elder fraud losses reached $61.5 billion in 2023, and the AARP reports that the average victims lose $120,000, which is often their life savings. These crimes are underreported due to embarrassment, fear, or confusion. Banks must proactively monitor accounts with behavioral analytics to flag unusual transactions. Employee training could focus on recognizing red flags and intervening respectfully. As suggested in the regulator's statement from December, institutions can also partner with community organizations to provide outreach, education, and tools for families concerned about an aging relative's financial safety. Next slide. Now we'll switch to some things that your bank can do in response to all of this. A comprehensive fraud strategy begins with leadership. Boards and executive management should designate a fraud officer or a team responsible for coordinating fraud prevention techniques across your different departments and across your institution. This could include compliance and operations, IT and customer service, and others. At Bankers Bank, we call this the fraud group. It's also important to support BSA reform by advocating for increased currency transaction report, or CTR thresholds, and more efficient suspicious activity report protocols. Current standards create an unnecessary, ineffective, and administrative burden, overwhelming institutions with low value reporting obligations. Banks should also push for actionable feedback from FinCEN and law enforcement. Too often, SARs go into a black hole with no visible impact, and we must all keep BSA guidance in mind. Programs are intended to be effective, not just in technical compliance. Fraudsters are agile and interconnected, so banks must respond likewise. This means building partnerships with technology vendors, telecom companies, and even competitors to share threat intelligence in real time. For example, through 314B voluntary information sharing through FinCEN. And as I mentioned several times, improving your know your customer tools, your customer identification program, and ongoing product and relationship monitoring is often going to be your best shot at reducing and preventing fraud. Next slide. AI-powered tools such as facial recognition, voice analysis, and behavioral biometrics are starting to become available in the community bank marketplace. Banks will need to scrutinize transactions, train staff, and collaborate to identify large fraud schemes. In crafting an effective response to fraud, execution matters. Every employee needs to be trained to recognize scams and escalation protocols, empower all call center staff to spot red flags, and to tactfully intervene when they believe a customer is being manipulated. Seek out outreach opportunities to help customers understand their role in preventing fraud and safeguarding their hard-earned dollars, and leverage social media, both as a communication monitoring tool. If a fraudulent trend is going viral, your bank should respond with equal speed, warning customers, reporting to regulators, and adjusting controls. Another response to emerging threats may be to revisit your bank's funds availability policies to prevent misuse via ATM deposits. This might include introducing alerts and holdups for suspicious remote deposits. Broader account monitoring tools designed to predict behavior could also add another layer of defense. Your bank can also adopt tools like Fraud Classifier and Scam Classifier. These models are work to improve internal fraud tracking because standardization provides clarity, and improves regulatory reporting and industry benchmarking. Implementing these models across your organization would enable for accurate assessment of scope and breadth of the fraud problem at your bank, as well as identifying emerging trends. Details on these models and how to implement them can be found at fedpaymentsimprovement.org. And finally, build a culture of curiosity, agility, and shared accountability. The fight against fraud is not one department's job, it belongs to everyone. And as pointed out in Governor Barr's speech in April, banks should heed the call to action, rapidly evolving their fraud prevention strategies and working together through collaboration and information sharing opportunities. Deepfakes can only be defeated through sustained collaborative efforts of financial institutions, regulators, tech firms, including core providers, and the public, your bank's customers, counteracting personal and systemic risks posed by rapidly changing fraud environment. Next slide. As I close out my portion of the presentation this morning, let me point you to some resources that can help you with all of this. There's no shortage of excellent tools online to support your fraud prevention efforts. First, the American Bankers Association offers a fraud risk center with toolkits, case studies, and regulatory updates. The Office of the Comptroller of the Currency provides fraud bulletins and consumer guidance. The FDIC's Consumer Resource Center includes educational materials for banks and customers alike. The Federal Reserve's Consumers and Communities section offers fraud prevention resources tailored to diverse communities. And as I mentioned before, fedpaymentsimprovement.org contains advanced fraud classification models and benchmarking tools. Bookmark these, share them with your teams. The better informed we all are, the stronger our defenses become. Last slide, Dave. Fraud has changed, and so must we. The tools and tactics and urgency we need to bring to this challenge will define not only our institution's financial health, but also our reputation and our relationship with the public. Fraud is everyone's problem. We must all strive to be part of the solution. Now I'll turn it back over to David.
Thank you, Shane. Well, we just heard about different types of fraud, and so we'll discuss reputational risks that could develop from fraud and other reputational issues using an ERM approach. What is reputational risk? So it's an incident or series of events, real or perceived, that negatively impacts the public image of an institution. That could be fraud issues, employee turnover, technology events, and we'll speak to each of those as we go along during the presentation. Frustration and the lack of an empathetic listener at your bank is usually the first stage of a reputational risk event. Social media has tremendously changed the landscape, and it's created a way to send out an amplified message from one person that reaches hundreds, sometimes thousands of others, usually with no context and only telling their side of the story. These are some common phrases you may hear from your customers when they become victims of fraud and can't get an answer or the answer they think is right from your bank. My bank allowed this to happen. They won't give my hard-earned money back. The local news outlet would love to put out a story about this. My daughter's on social media and has a lot of followers. She can help. There's According to a recent study by SAS that surveyed over 17,000 banking customers around the world, it's not all doom and gloom for digital banking. In fact, far from it. 65% will continue to use digital channels. 21% would use digital channels more often. Only 9% of people said they would use digital channels less. That means 86% of customers want to use online channels. And it's important to note that your digital banking platform has now become just as important to your customers as making an in-person lobby visit to do their banking. With this in mind, managing reputational risk through all delivery channels is vital to your public image. Fraud is here to stay, but you can take a more proactive approach. If you're always reacting to fraud, then your reputational risk is going to increase, eventually causing real damage to your hard-earned image in the community. Let's take a look and talk about some internal things you can do before you hear about fraud from your customers. If you don't have an internal expert, engage your law firm. Understand the law and how it applies to different types of fraud. Does your banking team in the lobbies know what to say? If a customer asks 10 employees and gets 10 different answers, then you're not conveying confidence. Educate your staff on how a situation should be escalated if a customer doesn't like the answer that they get. Also, do your managers know what to say when an irate customer on the phone gets transferred to them or an unconsolable visitor in the lobby gets ushered into their office? Your managers need to be educated about the law and the politics around customer service at your bank regarding fraud. Now let's talk about some external things you can do to inform your customers about fraud and get ahead of the message. The use of marketing to create an image of your bank out in the market is important. Safety and security, as well as empathy and confidence, is attached to your bank's image, and it's important for your reputation. Your banker should be seen as being reliable, responsive, empathetic, and competent. Get the fraud message out before your customers start talking about it with you. You can point to information on your website and social media platforms that talk about fraud because it makes you appear not only prepared, but understand the greater forces in the market. Use social media to bolster your image before reputational damage occurs. If you don't monitor your social media feeds for negative comments or posts, you might be allowing negative impressions of your bank to stay out there on social media platforms, and that damages your reputation in the market. And finally, are your calling officers and executives visible and well received in the community? If there's a negative reputational event, your valued customers might be more likely to talk to you about it instead of venting to others or using social media. Let's pivot to talking about reputational risk at your bank using ERM or enterprise risk management. There are indicators that can be used to measure reputational risk. And that's a question we get a lot with enterprise risk management's platform here at Bankers Bank is how do you measure reputational risk? So we're going to go into some of that. And also make sure it's properly weighted against other categories. At Bankers Bank, we weight reputational risk as 10% of our enterprise risk total. We weight it as heavily as strategic risk because we want to maintain a good impression of our brand, the professionalism of our bankers who serve our customers, and our offered products and services. Now, those of you who have joined us for other webinar topics, this is just a reminder about systemic risk. And I think it's an important fact that we talk about that for best practices for ERM, because enterprise risk management is a measure of systemic risk across your bank, not measuring risk within categories. We want you to break out of siloed risk thinking and consider how one risk measure could affect multiple areas of the bank. And reputational risk is a perfect example of this. As you'll see, it's hard to keep it confined to just one area. In fact, reputational risk could impact every risk category in your ERM structure if the event is severe enough. Remember, watch for trends and ask what is causing it. That's what ERM is all about. Some of these indicators may be ones you're already using. I'd also like to suggest some that you should include as well. Let's use Bankers Bank's Risk Insights tool to show how these risks can be measured. For these examples, we're using a demonstration bank and not an actual bank. To start with, here's an indicator that measures net new households who open accounts with the bank, monitored in their strategic risk category. Are they gaining new customers? In our example, this bank has shown that new customers grew by 15.5%, which is very healthy compared to their benchmarks. It's also well within their risk appetite and has a very low risk rating, which is good news for this bank. Now let's pivot and think about this risk measure in a different way. If the growth that was previously strong slowed measurably, it might be a result of a reputational risk event that occurred and the bank was not aware of it. Fraud loss versus bank loss. And so if we think about fraud loss to a customer versus what the bank lost, if the bank is 100% not losing money on fraud, but the customers are, then it's not always a win-win situation. These customers might want the last word if fraud cases climb, but the bank is the only one who's not losing a dime. And this indicator is currently being measured in the operational risk category. Critical system unavailability. And this is a risk measure that can be very systemic. And we're pivoting from fraud here for just a moment because I want to talk about systemic risks and how they can affect your reputation in different areas. And critical system unavailability for this demo bank is being measured in their operational risk category, which is quite common. So if their core system goes down at 2 p.m. on a Friday afternoon and it's down for the rest of the day, and the drive-thru's backed up and no one can do their banking, customers aren't going to rave about this bank during their Sunday barbecue. We can see that this outage, or maybe a series of outages, has exceeded our risk appetite. And so therefore we're getting a yellow flag. That's a warning that things aren't going according to plan on our risk appetite. Core systems aren't just for operational folks to get things done, or cybersecurity to keep patched and secure. It's just as much the face of your bank as the lobby is. Remember the high percentage of folks who are going to use digital platforms going forward. Most banking is done by mobile banking, so now it would be a huge impression on your customers. So having system outages requires an effort on your part to communicate with customers. They need to know how concerned you are about their inconvenience and that you're aware of the impact this event had on their banking experience. Formal complaints can't be ignored, so track these increases because it means customers are becoming less happy with their bank. Since this is our demonstration bank's sole indicator for tracking reputational risk, that's fine if they're new to ERM, but a few quarters in, they should add more indicators. And we'll look at why in just a few seconds. Why did these two customers make formal complaints about this institution? If we think back to the indicator that measured fraud loss to the bank, we didn't consider the customer's losses. Thinking of risk systemically, we might conclude that the bank's reputation could be impacted by those customers who feel they have no recourse other than filing complaints with regulators. And who else might they be talking to? To wrap up existing indicators, look at this example of our enterprise risk score using the indicators we have in place currently so far in the demonstration. Everything appears to be fine in the reputational risk category. If this bank doesn't develop additional indicators to track other reputational risk measures, they may not see the whole picture. Now let's add some new reputational risk indicators and see what happens to our enterprise risk score. Now let's go over a few enhanced indicators that you can use even starting today in your enterprise risk model, either using Bankers Bank's risk insights or your current measures. And so let's talk about fraud loss to customers versus the bank's loss. Because remember, if this bank is 100% not losing money on fraud, but its customers are, it's not always win-win. This indicator allows the bank to track quarterly changes in their customers' fraud losses. If the bank's number doesn't increase, but this indicator does, then a reputational issue could arise, and it's time to put the internal messaging and external marketing efforts into motion sooner than later. And we can see that the fraud loss amount to their customers this quarter is $28,000, which far exceeds the risk appetite set by the bank. Again, using enterprise risk management here is important because it not only tracks the amount that the customer is losing, but it also compares it against the benchmarks that you set for low, moderate, high risk, but also you can set a risk tolerance and you would know whether you had exceeded your risk tolerances at this point or not. Average officer tenure. Are this bank's customers seeing new faces every 6 months? Do they know who their bankers are? Do they know who to call? Banking is a very personal business. This measure looks good for them, which has an average officer tenure of 8 years. When we track the average years of officer tenure, if the number decreases, customers are becoming more likely to see new faces when they see their banker, which isn't great for this bank's reputation. If the number increases, the officer tenure is longer, so customers should really know their banker. Customer visits. I can speak from 20 years of banking experience that customers love it whenever we get out of our offices and we go visit our customers at their place of business. Build up goodwill in your customer base and make sure that they know you're a partner in their financial lives. How many calls on banks, or how many calls on customers did this bank last quarter? 128. Which is behind their goal of customer calls. So this bank needs to step up their calling efforts because customers aren't seeing their bankers outside of the branch according to the plan that they made for quarterly office visit goals. Here we can track impressions that are less favorable to your bank's image on social media. 6 negative mentions last quarter, probably from all that fraud reported. Remember the $28,000 the customers lost. This has greatly exceeded their risk appetite. With this enriched data in the indicator set, now we can see that all is not going well according to plan for this bank in their reputational risk category. There's a yellow warning flag, which means that they've exceeded their risk appetite by a little, but there's time to make some changes and bring that back down. And it's time to step up their external efforts on managing their reputation in the market. So to wrap up, have a plan to deal with fraud because it's not going away. Create clear, concise messaging that everyone in the bank knows. Create risk indicators that measure reputational risk. And if you take away anything from my half of the presentation, risk is systemic and it does not stay in silos. So at this point, we'll open it up for the questions that came in by chat. Jim, did we have anything come in?
Yes, thank you very much, Mr. Paxton. Just as a reminder to everyone, if you would like to submit a question, there's an icon at the top of the application marked chat that will open a window on the right-hand side of your screen for you to submit any questions. We have received some questions in a direct message format rather than via the open chat. So I'm going to relay those first and we'll continue to monitor the chat feature. Our first question is directed towards Mr. Bauer. During your section of the presentation, when addressing merchants and frauds, you mentioned something about triangulation. Could you please explain this further? Mr. Bauer.
Sure. So there's this lesser known e-commerce scam out there where a fraudster creates a website, looks a great deal like a legitimate merchant's website, and then gets traffic that consumers think they're going to the legitimate merchant site instead of to the fraudster. The fraudster then places orders at the merchant site on behalf of the customer. The merchant ships out the goods, but the payment goes to the fraudster. So it's a triangulation scheme because the fraudster puts himself in the way between the legitimate merchant and the customer. And then the fraudster keeps the money.
Thank you, Mr. Bauer. We have another question that was directly submitted, directed to Mr. Paxton. In your section, you were talking, we noticed that there was a change in regulatory, there was a regulatory announcement that came out related to
OCC.
reputation risks about their focus. Could you comment on that?
Yeah, we've actually had a lot of questions about because the OCC said they were removing their reputational risk from their handbooks. And so customers have been asking us, why are they doing this? And I think it's important to note that reputational risk is being removed from their handbooks, but it's not going away from banks. They're not necessarily worried that customers are upset, but they want to know why. So an examination issue would focus on the root cause and address the systemic risk of that. If your customer is unhappy with your response to fraud, for example, actions under your control before the loss may have led to the complaint, and they're going to want to know about that. So reputational fraud isn't going away, but the root cause of it is going to still be your responsibility. So it's just as important as ever to monitor your reputational risk, because that is the so to speak, that's where the rubber meets the road for some of your practices within the bank.
Thank you. And we have one more question from Mr. Bauer that's been submitted. You mentioned two resources in one of your slides. One was fraud classifier, and the other one was, it looked like scam something. Could you explain these?
Sure. So the Federal Reserve Bank has developed a couple of different models that are used to classify and thereby track fraud across an organization and create a organization-wide picture of fraud trends. And these are fraud classifier, which is a few years old now, and scam classifier, which is newer, I think maybe 2 years old. And these models allow a bank to classify fraud for their organization across all payment types. So each of the different payment types today have their own rules and regulations, their own associations, and that means they all have their own definitions of fraud. That makes it very difficult for a bank to figure out what their actual total fraud exposure is, because there aren't even common definitions across different payment types. What fraud classifier does is it allows you to classify fraud based on the characteristics, like who started it and who was deceived and so on, rather than the rail that's being used. And that allows you to have a bank-wide picture of the fraud at your organization, and also gives you a way to do apples-to-apples comparisons for industry stats and such. A scam classifier is very similar, but it focuses on different types of scams that are available and also allows a bank to classify those within their organization. And those are both available as resources for free on the website fedpaymentsimprovement.com. Nope, I think it's .org, fedpaymentsimprovement.org.
Thank you very much. We have another question submitted for the slide showing with the demo bank that was being shown. Was that a specific risk management platform that was being looked at, and what platform is that, Mr. Paxton?
Oh, that's very near and dear to our heart. Actually, Bankers Bank created our own enterprise risk management platform. It's called Risk Insights. And we created that internally for Bankers Bank because we've been users of enterprise risk management for 8 years. We partnered with an external firm for quite a while. We found it was just too robust for community banks like ourselves and probably for our customers. And so therefore, we undertook a project and we built one ourselves internally. We used it internally for 3 years. We had some demand from customers out in the market for an enterprise risk management tool. And so about a year ago, we rolled that out for our customers in the market. So that is Bankers Bank's Risk Insights. And so if anyone is interested in hearing more about that product, please reach out to me. And I'll be more than happy to give you a demonstration on how that works and how it can help community banks. Typically less than $5 billion, it's a perfect sized platform for banks who want to dip into ERM. And we can project manage the implementation of that for you. So you don't have to worry about months and months and hours of creating it from scratch.
Thank you very much. At this point, those were all questions so far submitted. During the closing remarks, if there is any additional questions submitted, I will interrupt and request that. But otherwise, Mr. Paxton, we'll turn it back over to you.
Well, it's been a pleasure being your host today, and thanks for joining us. We hope that you gained some useful knowledge about fraud and reputational risks. Bankers Bank can offer you professional assistance with handling risk through our Risk Management Solutions division. Make sure you take the survey, as your replies will help us create our next quarterly webinar, which will be, I believe, in July. And look for a recording of this webinar in your email, which will go out very soon. And if you have any other questions, just feel free to reach out to us at Bankers Bank, and we'll give you a quick reply. Thank you all and have a great day.
Thank you.